Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. We've sifted through a stack of the latest from places like CNBC, Reuters, Bloomberg, and we're ready to, dig into the most important bits for you.
Yeah.
Today, it's a real mix. We've got global trade stuff, central bank decisions, some surprising company news.
Right.
Think of this as your shortcut to getting up to speed on the day's financial pulse.
Exactly. And what's really fascinating, I think, is how connected all these things are.
Yeah.
We'll be trying to connect the dots between, say, international talks, how specific companies are actually doing,
Okay.
and what that all means for the bigger economic picture. The main question we're kind of asking today is, in this financial world, dealing with so much uncertainty, how are markets actually finding some stability? With political pressures, trade wars still rumbling, companies shifting strategies.
Yeah, it feels like a lot is in flux.
It is. It's a busy day. Definitely a lot to unpack.
Okay, let's dive in then. Let's start with that big piece of news out of Sweden. CNBC reported it. U.S.-China trade talks wrapped up, but no extension on the tariff truce?
Right. That's the headline.
And U.S. negotiators are saying, look, nothing's final until President Trump signs off. Commerce Secretary Lutnick confirmed Trump's Friday deadline for tariffs on other partners. That's still on.
No delay there.
But he did mention the China talks are on a separate track, progressing separately. So what does this mean right now? For markets, for you listening.
Well, yeah, that raises the key question.
Mm-hmm.
What's the real impact here? Treasury Secretary Scott Bessent, talking to CNBC, tried to kind of downplay it.
Oh, yeah. How so?
Said it's not the end of the world if these snapback tariffs kick in for a bit. The old higher rates coming back.
For a few days or weeks, he said.
But then you have UBS, their CIO, Ulrich Hoffman-Borchardt, warning that, look, tariffs, even lower ones, there's still a drag on growth. No way around it.
So what are we actually looking at? Potential rates?
We could be looking at 15% to 20% blanket tariffs for countries that don't have deals by Friday.
Wow.
And for China, CNBC's Daily Open noted tariffs could boomerang right back up to April levels by August 12th if they don't get an extension sorted.
Okay, so definitely something markets are watching closely, or maybe the lack of clarity is the thing?
Exactly. Uncertainty is rarely good.
And what really brings this home, I think, is seeing how it hits actual companies. Jim Cramer on CNBC's Mad Money, he pointed this out.
What did he say?
He was talking about recent earnings misses. Companies like UPS, Whirlpool, Stanley Black & Decker.
Yeah.
He's saying these aren't just random misses. It shows the tariffs are hitting consumers, hitting the economy directly.
Makes sense.
Like UPS, they specifically mentioned on their earnings call, quote, U.S. consumer sentiment that was at historic lows.
Ooh, yeah.
And Stanley Black & Decker, they're expecting an $800 million hit this year, just from tariffs.
$800 million.
So yeah, these aren't just abstract policy debates. It's real money, real impact on confidence.
That's a really critical connection to make, absolutely. But it's not entirely doom and gloom everywhere.
Okay.
If you look at the bigger picture, you also see companies, adapting, finding ways.
Like who?
Well, Logitech International, for instance, they're making pretty good progress shifting production lines out of China.
Oh, interesting. Reuters reported on this.
Yeah, their CEO, Hanneke Faber, said they're aiming to cut the percentage of U.S.-bound stuff made in China from 40% down to just 10%.
10%.
By when? By the end of the year. And, crucially, they say they're doing it without significant cost increases.
That's impressive.
It really is. And what Logitech's move kind of shows, it suggests that supply chain resilience, not just chasing the lowest cost, is becoming the new name of the game for manufacturers.
So being flexible is key.
Exactly. It's a critical shift for you as an investor to watch. Companies that can pivot like that might just outperform those stuck in the old ways.
Okay, let's shift gears a bit. While trade is grabbing headlines, there's maybe a glimmer of something positive in Europe.
Yeah, actually, Reuters had some, surprisingly decent news. The Eurozone's Q2 economic growth.
Yeah.
It held up better than analysts feared.
How much better?
It expanded by 0.1%. The expectation was basically flat, no change.
Huh. Okay. Any standouts?
Spain and France did better than average.
Yeah.
They kind of offset the weakness we saw in Germany and Italy.
So some resilience there despite all the global uncertainty. That's definitely a key takeaway.
And resilience is important. Yeah, it offers a bit of stability. But then you look at the new EU-US trade agreement announcement and things get murky.
Murky how?
There's a really notable difference between what each side said they agreed to.
Okay.
So the White House summary, according to CNBC, claims the EU agreed to buy significant amounts of U.S. military equipment. President Trump even mentioned hundreds of billions of dollars in arms deals.
Hundreds of billions, wow. Okay, and the EU side?
Well, the EU's own statement, also reported by CNBC, talks about $600 billion in private sector investment in the U.S. In buying energy and AI chips. But no specific mention of military equipment purchases.
Wait, really? No mention at all?
None specifically highlighted in their readout. So you have analysts like Simon Evenet from IMD using phrases like smoke and mirrors.
Huh, smoke and mirrors. That's quite a gap in the story. So what does that ambiguity mean? For trade or for, say, Europe's defense companies?
Well, European defense stocks did wobble a bit initially after the announcement.
Understandable.
But analysts talking to CNBC are mostly saying those fears are probably overblown. They argue European firms will still get the lion's share of bigger national defense budgets in Europe.
Why is that?
Exactly. Dean Turner from UBS Global Wealth Management pointed out to Reuters, part of the reason is simply there isn't enough manufacturing capacity inside Europe to meet all the rearmament demand right now.
Okay, so even if they wanted to buy everything European, they couldn't.
Pretty much. So some of that spending has to go elsewhere, like the U.S., regardless of the specifics of this trade deal language.
It's a complex mix, then. Politics, industrial reality, and market perception.
Definitely. And it raises a bigger question, right? If Europe needs to boost its defense, but can't make enough stuff internally, what does that really mean for their long-term industrial plans? For that push towards strategic autonomy they talk about?
Good question. Okay, let's bring it back stateside. All eyes on the Federal Reserve today. Policy meeting wraps up.
Yep. Big day for the Fed watchers.
Now, the general expectation, as noted by CNBC and Yahoo Finance, is they'll keep interest rates where they are.
Right. That's the consensus. Hold steady.
But there's this backdrop of really significant and very public political pressure on Fed Chair Jerome Powell to cut rates.
Oh, absolutely. And that's what's striking here. Yahoo Finance has covered this extensively, the ongoing tension between President Trump and the Fed.
He's been very vocal.
Extremely. Publicly pushing Powell for cuts, questioning the Fed's independence, even calling for reviews of how they operate.
How are Fed officials reacting? Are they all aligned with Powell?
Mostly, yes. Most seem to agree with Powell that they need more time to see how tariffs really play out. But some are seemingly warming up to the idea of a cut. Christopher Waller, for example, he thinks the tariff inflation impact will be temporary.
Interesting division there.
Yeah, and you have former Fed presidents, like Esther George, expressing concern. She highlighted that this kind of public campaign is damaging and erodes the Fed's credibility long term.
It's definitely unusual. So this really prompts a question for you, our listener, to think about. What does this kind of sustained public pressure actually do to the Fed's credibility, its independence in the long run? Powell keeps saying he won't leave early, and Yahoo Finance notes he legally can't just be removed. But the perception of political meddling, that itself can create a weird dynamic for markets, right?
Absolutely. It's not just about the economic data anymore. It's about trust in the institution. Trust that decisions are data-driven, not political.
And if that trust wavers...
that could have real implications for market stability down the line.
Okay, let's zoom in now on some specific companies. See how they're navigating all this complexity, from finance to EVs to tech. We're seeing some interesting moves, some struggles, some resilience.
Right.
First up, HSBC, Europe's biggest bank. They missed their Q2 profit expectations.
Yeah, saw that. Pretty big miss, too.
Yeah, CNBC reported a 29% drop compared to last year. They did announce a $3 billion share buyback. But the miss was mainly down to impairment charges, basically writing down asset values plus higher operating costs from restructuring and tech investments.
So, taking some hits.
A significant miss for a giant like HSBC, yeah.
And, this might not just be an HSBC story. If you connect it to the wider banking sector,
yeah,
it kind of highlights the huge pressures these big traditional banks are under. They're restructuring internally, and they have to keep pouring money into technology just to keep up.
Right. A double whammy.
Yeah. So that share buyback, you could see it as giving something back to shareholders when earnings disappoint, but it also makes you wonder, is this just a short-term fix, or does it point to a deeper challenge for these big legacy banks?
Interesting point. Okay, moving to the EV world. Chinese maker Li Auto, their shares took a tumble, didn't they? Down over 11% Wednesday.
They did, yeah. CNBC reported that came right after they launched a new 6-seat electric SUV, the Li i8.
So, new product launch. Usually good news. What went wrong?
Well, experts talking to CNBC said it reflects real disappointment. both from consumers and investors, about their product strategy, the timing, and just the intense competition in the EV market right now.
What specifically disappointed them about the car?
Macquarie's analyst Eugene Xiao pointed out that the lower-end version of the i8, it was missing features people kind of expect from Li Auto, like the built-in fridge or the big cinema screen.
Okay, so it felt like a step down.
Kind of. And it just shows, doesn't it? In a super crowded, fast-moving market like EVs, you can't just launch anything. It has to hit the mark on innovation, value, meet those high expectations.
Yeah.
One wrong move.
And the market reacts immediately, painfully. Okay, then there's Starbucks. A bit of a mixed bag here, right? CNBC reported they beat revenue expectations.
Yeah. Top line was okay.
BUT, it was their sixth straight quarter of same-store sales declines. That's quite a streak.
Its quarters is significant, yeah.
Yet CEO Brian Niccol says the comeback is gaining momentum. He's pointing to investments in Green Apron service that's about better staffing, barista engagement, and new drinks coming, like protein cold foam.
Okay, so they have a plan.
Apparently. And what's fascinating is despite those falling sales, the stock actually went up 3% in extended trading. What do you make of that?
Well, this is a classic case of the market looking ahead, isn't it?
Betting on the turnaround.
Exactly. Investors seem to be buying into the leadership's story, into their vision. They're placing a bet that these investments, like improving the service, fixing staffing, that will eventually turn those sales numbers around, and that new drinks will bring people back in.
So it's a vote of confidence in the strategy.
It seems like it. It's definitely a risk, but it shows the market often invests in the narrative of recovery, not just the current numbers.
Speaking of market expectations, let's touch on tech IPOs. Jim Cramer on CNBC, he sounded a bit hesitant about the Figma IPO.
Oh, yeah. What was his take?
He said he likes the business itself, fundamentally, but he's worried it might just be too expensive right at the start.
Valuation concerns.
Yeah, especially because, and he quoted the CEO here, AI investments could be a drag on efficiency for several years.
Ah, okay. That's a really interesting point about AI costs.
Affecting profitability in enterprise software?
Yeah, exactly. And that's not just about Figma. It's kind of a broader warning sign for tech companies, isn't it? AI is obviously huge, the future. But the cost of developing it, integrating it, scaling it, that can really hit profits in the short term.
So even with the long-term promise?
It raises a bit of a red flag for investors right now. Makes you rethink those high valuation multiples when AI is both this massive opportunity and a big upfront cost.
Right. And finally, sticking with AI, a split among the tech giants on regulation.
Yeah, CNBC reported this. Google says it will sign the EU's AI Code of Practice.
Why?
They're hoping it promotes access to new AI tools, even though there are worries it could slow down development in Europe.
Okay, so Google's in, but not everyone.
Right. Meta, remember, previously refused to sign. They called it an overreach that would stunt innovation.
So two very different approaches there.
Totally different. And it shows how these huge companies are positioning themselves strategically as the rules for AI are still being written.
It's not just about the tech, it's about navigating the rules.
It's exactly. Is Google trying to shape the rules from the inside, maybe get an edge? Is Meta betting on less regulation, leading to faster progress? It tells us the future of AI isn't just about breakthroughs. It's also about how these giants play the global regulatory game.
Okay, so let's try and pull this all together. What does this whirlwind tour mean for you, trying to make sense of this financial world? Well, today's deep dive really paints a picture of an economy, of markets constantly adapting under some serious ongoing pressure.
Yeah, adapting feels like the right word.
We see companies like Logitech finding smart ways around trade problems, others like Li Auto getting instant feedback if their strategy misses the mark.
Right.
We're watching central banks like the Fed dealing with this unusual political heat.
Yeah, unprecedented, really.
While also seeing surprising resilience, like that little bit of growth in the Eurozone.
So if we go back to that central question, how are markets finding stability amid all this uncertainty? It highlights something crucial, I think.
What's that?
In a world where trade wars and new regulations are constant unknowns, markets aren't always just reacting to the hard financial numbers.
Okay.
Michael Kantrowitz at Piper Sandler, he suggested this on Yahoo Finance. Maybe the current rally on Wall Street isn't about amazing earnings. Maybe it's more about relief.
Relief. Relief that things aren't worse.
Exactly. Relief that maybe the worst case scenarios haven't happened. Which raises a really important question for you to mull over.
Go on.
How much of what we're seeing in the markets right now is built on real, fundamental economic strength? And how much is just a A collective sigh of relief that things could have been much tougher.
That is a lot to think about. Definitely a lot of moving parts out there today.
For sure.
We hope this deep dive has given you a clearer, more informed perspective on what's driving the markets. And we'll see you all tomorrow morning with new headlines from major financial magazines.